Well, hey everybody, welcome back. I'm Professor Jeff Byrne, and today we're diving into one of the most powerful tools for analyzing business performance, variance analysis. This isn't just about crunching numbers, it's about turning budget surprises into strategic decisions. And to bring it to life, we're heading back to the world of sticky oats. By this time, we're not planning budgets. This time, we're reviewing the damage from last quarter. The CFO, the ops lead, the HR director, and the controller just left a tense meeting, and things aren't adding up. Let's find out why. So here's our agenda. We'll start by explaining what standard costs are and why Sticky Oats uses them, not just to plan, but to monitor performance. Then we'll walk through a sales variance analysis where the big revenue jump came from, a breakdown of direct materials, how much of the cost spike was from higher oat prices versus just using too much, a look at direct materials, was overtime the real villain, and finally we'll explore variable manufacturing overhead, including machine hours, support labor, and energy use. At the end, we'll interpret the whole picture, because calculating a variance is just the first step. What really matters is how managers use that data to take action. If you haven't done so already, I suggest printing out the slides and grabbing a pencil. This one has a few numbers and calculations, but will be an amazing tool in your managerial tool belt. All of that and more right here in this vodcast. So here's what happened last week at Sticky Oats. The CFO, Eli, walked into the executive meeting with a big grin. Sales had come in over $100,000 above forecast, and he was feeling pretty good. But across the table, Maya, the head of operations, wasn't smiling. The materials budget was blown. They'd gone through way more oats than planned, and she wanted to know why. Devin from HR added that labor costs had spiked too. Overtime was off the charts. And then all eyes turned to Janelle, the controller. Calmly, she said what everyone in the room was really thinking: let's run the standard cost variances. I'll figure out what price-driven changes and what volume-driven changes really led us to miss the mark operationally. And that's where we come in. In this podcast, we're going to walk through the same analysis Janelle's running behind the scenes, unpacking the numbers, tracing the variances, and learning how to explain them in a way that drives real decision-making. Before we jump into the variances, let's take a second to understand what standard costs really are and why Sticky Oats or any well-run company uses them. So a standard cost is a budgeted or expected cost for a specific input, like raw materials, labor hours, or machine time. We calculate it by multiplying two things: the standard quantity of input we expect to use, like the pounds of oats per case, or labor hours per batch, by the standard price or rate, like the expected cost per pound of oats, or the hourly labor wage. So for example, if Sticky Oats expects each case of oat mix to use 1 pound of oats at $10 per pound, that gives us a standard materials cost of $10 per unit. The same logic applies to labor and overhead. Now, here's why this matters. These standard costs are built into budgets and forecasts, performance evaluations, bonus systems, and even inventory valuation and cost accounting systems. And more importantly, for our purposes, they allow us to compare what actually happened to what should have happened based on actual production volume. This lets Janelle, the controller, pinpoint whether a cost variance came from paying too much, a price or rate issue, using too much, an efficiency issue, or simply producing more or less than expected. Without standard cost, all she sees is what the total cost changes were. With these standards, she can trace it back to the cause and, more importantly, assign responsibility. It's not about blaming people, it's about managing intelligently. Now that we understand what standard costs are and how they help us compare expectations to reality, let's start applying those ideas to Sticky Oats' actual October results. And we'll begin at the very top with the sales revenue. Before we get to cost, we will understand how much more revenue Sticky Oats brought in and why. Because even though more sales sounds like a good thing, they can come with some hidden cost. So we'll break the sales variance into two parts. one from price and one from quantity. Let's break down the surprise win from Sticky Oats October sales. So they expected to sell 10,000 units at $50 each, totaling $500,000. But they actually sold 11,000 units at $55 each, totaling $605,000. That gives us a total sales variance, or TSV, of AQ, actual quantity, times AP, actual price, minus the standard quantity, SQ, times the standard price, SP. Or in other words, $605,000 minus $500,000 gives us the total variance of $105,000. And that's favorable, more than what we planned. We break this total variance into two components, a sales price variance, or SPV, and a sales quantity or a volume variance, SQV. For the sales price variance, this tells us how much of the variance came from charging a higher price than expected. Okay, we know that it was $55 versus $50. What did that mean in total dollars for us? It's $55,000. Well, this is the equation that we get to that. SPV, sales price variance, equals the actual price, 55, minus the standard price of 50, times the actual quantity of 11,000. That's how we get the $55,000 favorable variance. Okay? The sales quantity, or the volume variance, this tells how much came from selling more units than planned. SQV equals the actual quantity, 11,000, minus the standard quantity, 10,000, times the standard price of 50, or a $50,000 favorable sales quantity variance. Since those signs are the same, they get added together and they account for the total sales variance of $105,000. Janelle, the controller, can now say with confidence that both the marketing and pricing teams contributed to this revenue bump, and she'll compare this against the cost side next. So now that we've broken down the sales variance, it's time to tackle the real source of friction in Sticky Oats October's performance, the cost. Remember, the company made an extra $105,000 in revenue, but the question on everyone's mind, especially Maya and Devin, is whether that extra volume actually helped or hurt the bottom line. To answer that, we shift from looking at revenues to analyzing cost variances. And to do that, we use a framework you'll see throughout this video here. It's the general model for cost variance analysis. As the graphic on the right shows, this model breaks each cost variance into three logical layers, and they map directly to three columns in a variance table. Actual cost is on the far left. It's what we actually spent based on real inputs at real prices. The flexible budget's on the far right, aka as if cost. It's what the cost should have been based on actual production volume, but using standard rates. Now, the middle column has several different names. Some call it the standard allowed cost. Others call it just the separating column. It's basically used to separate the spending variances into the price and quantity variances, the two subcomponents. You can also think about this as what we expected to spend based on planned volume and standard rates. Here's how the model helps us isolate where things went wrong or right. We first ask, how much more or less did we spend than we expected overall? That's the spending variance. That's the total difference between the actual and the expected cost. Then we ask, did we pay more or less per unit of input than planned? That's the price or the rate variance. And finally, did we use more or fewer inputs than we should have? That's the quantity or the efficiency variance. So the overall spending variance is broken down into two portions, a price variance and a quantity variance. Those two combined together equals the spending variance. And this same model applies whether we're looking at materials, labor, or overhead. And it's how Janelle, the controller, diagnoses the problem across the departments. Okay, so now that we've seen how the general model for variance analysis works in theory, let's apply it to Sticky Oats, to their biggest cost input, oats themselves. Remember, oats are budgeted at 1 pound per case at a standard price of $10 per pound. Sticky Oats produced 11,000 units, So they should have used 11,000 pounds. 11,000 units times 1 pound each, 11,000 pounds. At that standard price of $10, it should have cost them $110. I'm sorry, $110,000. And that's what we're seeing in this far right-hand column. We see the standard quantity at the actual output. They should have used 11,000 pounds. At $10, $110,000 was the budget. Let's now compare that to what actually happened. They used instead 13,200 pounds of oats at a price of $9.50 for the total actual cost of $125.04. Okay, so now let's walk further. Take a look at this separating column, as it's often called, and just remember, we're kind of taking these bookends, AQ and SP, and that's what's getting multiplied together. So AQ was 13,200 actual quantity. That's the number of actual pounds of oats that was purchased, times that standard price of $10, meaning that $132,000 is in our separating column. So this is what they should have spent for that same quantity if they paid the expected rate. 13,200 pounds times $10, $132,000. Okay? Now we're ready to calculate the price variance. Essentially, we're taking a look at the actual price minus the standard price, $125.04 minus $132,000, and that comes up with $6,600 favorable. Another way to think of this is they should have spent $10 per pound. They spent $9.50 per pound. They had a 50-cent savings. 50-cent savings on the 13,200 pounds comes up to a total savings of $6,600. In cost variance analysis, savings are favorable. Next, it's the cost of using 13,200 pounds of oats at the standard price versus the 11,000 that they should have used at the standard price, or 132,000 minus 110,000, which is a 22,000 unfavorable variance. They used more quantity than they should have. Another way of thinking at it is this. They used 13,200 pounds. They should have used 11,000 pounds. So altogether, they used 2,200 pounds too much. At the standard price of $10, that yields the quantity variance impact of $22,000. Since they used more than they should have, that's unfavorable. So the overall total spending variance of $15,400, that's the difference between what they actually spent, $125.04, and what they should have spent, $110,000, $15,400. That's broken into two components. The price variance, which was $6,600 favorable, the quantity variance was $22,000 unfavorable. They had a favorable price variance because they got a better price on this stuff. They had an unfavorable quantity variance because they used way too much stuff than they should have. So we combine these. We take the smaller from the larger when they're opposing signs. If the signs are the same, favorable, favorable, unfavorable, unfavorable, we just add them together. When they're different, take the smaller from the larger, and the larger sign carries forward. So in this case, overall, we get an unfavorable variance of $15,400 when it comes to our direct material oats. The three-column approach is handy, but now let's bring in the math and show how we calculate these variances using actual formulas. So first, we can take the MQV, the material quantity variance, and basically we're looking at the difference between the actual quantity and the standard quantity, AQ minus SQ, times that standard price. So the difference, 2,200 times $10, is the unfavorable variance of $22,000. Next up, for the material price variance, we're basically looking at the difference between the actual price we paid of $9.50 minus the standard price of $10 times the actual quantity this time. So that 50-cent savings times the 13,200 pounds that we actually did resulted in the $6,600 favorable variance. So a much faster way to solve for the two subcomponents of the spending variance is using the equation format. After analyzing oats, Janelle moves to the second largest cost category at sticky oats, direct labor. This is where Devin and from HR had flagged concerns, too many hours, too much overtime. Let's apply the same three-column model we used for oats and follow up with equations to confirm the exact same impact of both rate and efficiency differences. So the three-column model again shows this. On the left-hand side, the actual hours that were used, 6,600 at $26 a piece. We should have used 5,500 hours at $24 a piece. This actual cost that we had to spend for labor was $171,600. We should have spent $132,000. This leads to an unfavorable variance of $39,600. We spent more than we should have, $39,600. But we want to break that down into this two subcomponents of labor rate, the price portion, and labor efficiency, the quantity portion. So let's do this as well. We're basically taking the entire amount that was paid for actual labor and subtracting that from the same actual hours, but if they had paid the standard rate of $24. So $171,600 minus $158,400 is $13,200. Another way to think of this, and that's unfavorable. And another way to think of this is they paid $26 per hour. They should have paid $24 per hour. So that $2 difference times the 6,600 hours gives us $13,200. And that's exactly what the labor rate variance formula also calculates. 26 minus 24, the actual minus the standard, times actual hours of 6,600, unfavorable variance 13,200. Okay, now how about the total hours? We look at the labor efficiency variance. They should have spent for this quantity 5,500 hours at a price of 24. They actually had 6,600 hours, so we're looking at the difference of those hours at those rates. 158,400 is what they should have spent for this quantity. 132 is what they actually spent. The difference in the labor rate variance is 26,400. Those extra 1,100 hours that they spent at the standard rate of $24 yielded an unfavorable variance of 26,400. This is what we see in the equation method as well too. The actual hours, 6,600, minus the standard hours of 5,500, 1,100 hours, times the $24, the total unfavorable labor efficiency variance is 26,400. Since these signs are the same, we simply combine them and know that overall, well, things fell apart with regards to how much we paid people for and how many hours folks worked as well too. That led to the combined total spending variance for direct labor of 39,600 unfavorable. Okay, the exact same format again here for our last major category, variable manufacturing overhead. This is things like electricity, machine maintenance, indirect materials, support staff. At Sticky Oaks, this is applied based on direct labor hours. So the same inefficiencies that affected labor can also impact variable overhead. Remember, we used 1,100 too many hours when it came to direct labor. Well, we're doing the same thing here when it comes to variable overhead. Notice that the rates are the same, standard rate of $6, actual rate of $6, so that's going to lead to no variable manufacturing overhead rate variance whatsoever. This is going to lead, though, however, to a variable manufacturing overhead efficiency variance because 1,100 hours were used too much at the rate of $6 leads to 6,600 extra dollars paid in cost for variable manufacturing overhead. So from the equations, nothing whatsoever because there's no difference in the rates, but on the actual hours, 6,600 minus 5,500 times that standard rate of $6 does come up with that 6,600, and that is unfavorable. This is a perfect example of how inefficiencies cascade. Slowdowns in labor also push up overhead. Janelle has now a complete breakdown of all three cost categories. Material, driven by usage. Labor, hit by both rate and time. Variable overhead, driven entirely by time. So now that we've gone through each cost category and the variances in detail, let's take a step back and look at the whole picture. Sticky Oats had an impressive 105,000 favorable sales variance from selling more and raising prices, but on the cost side, it didn't go quite as well. Here's the full breakdown. Total materials were 15,400 unfavorable, excess usage despite having those price savings. Labor was 39,600 higher because of a higher hourly rate and a higher number of hours that workers used to put together all of the oats that were sold. Overhead was 6,600 higher, tied directly to the excess labor time. Overall net variance 43,400. The key insight here, growth was profitable, but inefficiencies really threatened the margin. So you might be asking, why do we do all of this? Why spend time calculating price variances, labor inefficiencies, overhead absorption? Well, because variance analysis turns raw numbers into insights. It helps managers understand where performance drifted from expectations, identify whether the issue is price, efficiency, or just volume, and take the targeted action, know exactly what we need to do next time. It's not about assigning blame, it's about uncovering the real story behind the results and using that story to drive better decisions going forward. That's why variance analysis matters. Well, okay, I know that was heavy, so let's bring it all together. In this vodcast, we started with the story of Sticky Oats, and they had a great revenue quarter, but lots of open-end questions about cost. We used that real-world scenario to explain what standard costs are and why companies use them, to break down the sales variance into price and quantity components, to diagnose cost overruns into direct material variances, direct labor variances, and variable overhead variances, and apply the general model for variance analysis, helping us to separate rate issues from efficiency problems. And finally, we pulled it all together to see what the full performance story told us. You've now got the tools to go beyond just what happened and start answering why it happened, and more importantly, what we should do next. So get ready. You'll be using these tools in class, in case discussions, and maybe even in your job before the semester is over. That's all for now. Let's go.